Hi, folks. Hello. Jeff Clark here. Excited to do a webinar here. I think we called it OmniFlex short-term care versus traditional long-term care and hybrid plans. Just going to do a slower introduction as I like to do sometimes. I'll actually take the webcam off here so you can see more of the screen. I'd like to kind of give you a little idea of a background on myself and also kind of tell you what the premise behind the webinar today was. And just a little bit on myself. My name is Jeff Clark. I've been a regional director here with GoldenCare for over 20 years. I've been in the industry for 26 years. I've written, placed over 650 long-term care policies. About 20 years ago, I got moved into this regional director role with GoldenCare, where it's my job to basically compare, contrast, do proposals, game plan with our agents, train them on the different products, depending on what they bring me, you know, whether it's a widowed lady with osteoporosis and a compression fracture or a healthy married couple. We try to help our agents with the best plans. We cover all the plans across the board at GoldenCare, whether it be home care, short-term care, long-term care, hybrids. We do a lot of Medicare as well, but we try to cover the whole spectrum in the extended care market is what we like to call it now. So with that, again, I've got about 25 years of experience. I do enjoy actually comparing and contrasting them. And today, you know, we're going to be taking a little closer look at the short-term care plans. And I always kind of say, where did this webinar idea come from? Well, in talking to agents about short-term care, you know, when I talk to a lot of them, a lot of regular long-term care agents that have maybe been doing it for 15, 20 years, your experts, if you will, your people with a lot of experience. When you bring up short-term care, for some reason, it has this lesser connotation to it. That somehow it's just not as good as a product as, you know, long-term care, and it's almost beneath the real long-term care experts out there. And I have to admit, I may have been in that category. I kind of looked at short-term care as maybe a solution for a decline. I didn't really think of it as a great viable solution for people's long-term care needs. So anyways, as this market's progressed, my opinion has changed. And so I'm trying to kind of do that also on this webinar, explain to you that I do think short-term care belongs in conversation. And, you know, the topic this one is OmniFlex STC traditional versus traditional long-term care. I kind of want to take that down a little bit. You know, this isn't necessarily a competition. You know, there are a lot of solutions out there, and I feel like there's not a single solution for extended care that works in every situation. Everything's a little bit different, depending on people's health, their age. Maybe they've got money sitting around in the life for a annuity where they're going to move it into a hybrid plan. Or every individual situation is different. So I think we get in trouble when we start thinking that this is always the best solution. You know, hybrids are always the best. Traditional long-term care is always the best. In my, I guess, humble opinion, I'm finding that every situation is different. So as I go through this, please don't let it sound too much like we're competing. More or less, we are just showing you the different options. So with that, let me go ahead and move forward. I'll come back out, maybe put my cam back on here again for questions. So let's under presentation mode. Okay. All right. So like I mentioned, OmniFlex short-term care. You know, what we really basically said is the poor long-term care plans out there have been really kind of minimalized. People don't think of one that much. So I hope today we're going to take a harder look at short-term care plans, and mainly the OmniFlex, and show that they do have some pretty good, robust benefits, and they deserve to be in that conversation. Before I do that, I've been doing this in all my webinars. Before I start, you know, long-term care, short-term care, let's call it extended care, has never been more in the forefront than it has been in the last couple of years, mainly because of COVID. You know, since COVID, 90% of married couples have never had a real discussion about long-term care, and 90% of married couples will require some type of care. 61% of people surveyed on a Gallup poll recently said they'd rather die than go to a nursing home. Long story short, people are terrified of going to an assisted living facility or a nursing home right now, largely because the care. You know, the other Gallup poll said that if you received your care, someone that needed care, whether they had a stroke, whether they had a heart attack, whatever it was, they're getting home health care or needed to go to a facility. If you receive that care at your home, you had a 3% chance of contracting COVID. If you received your care at a nursing home, you had 11 times more risk of contracting and dying from COVID. Seniors know this. If there's 11 times more likelihood that I'm going to die if I get my care at nursing homes, people didn't want to go to nursing homes to begin with. So this slide I try to show every time. Consumers are worried they'll end up in a facility. They are really waiting for us as agents to go and talk to them, more so than any time that I've seen in my 26 years. People are very receptive to talking about it. There's just not a lot of agents mentioning it. So, and I'll probably say this a bit later too, but start that conversation. We do have a lot of stuff at GoldenCare to kind of help you start that conversation, either social media stuff, some emails, ways to kind of enter into that. We have webinar and training on that. How to start. It's a great thing to mix with the Medicare when you're doing your Medicare reviews this year. It's an outstanding time to mention them what they're doing about their extended care after you've got their prescription drug plans put to bed and their Medicare supplements, and just ask people, because again, 90% of married couples will require it, and 90% of adults have never had a real discussion about it, and they want to. I think I saw another stat recently, 70% of people are looking to have that conversation. Okay, all right. So shifting market. We've talked about this in another webinar I did, that the long-term care market has been kind of declining, and that's largely because people use these policies. A lot of long-term care companies were in this market. 80 companies some 10 years ago. We're down to about 3 now that you can actual broker, and that's largely because, again, it got very expensive, very claim intensive on those long-term care companies. They just kind of shied away from it. We saw a lot of movement towards the hybrids, but traditional long-term care markets companies were getting beat up, and so a lot of them have gotten out. And again, it's hard. If you're in the long-term care market, it's hard to place things. Premiums have gone really up. And so we're seeing a lot of shifting now, kind of a paradigm shift, if you will, of long-term care plans now looking more at short-term care. And I guess after today, I hope you guys can understand why we're doing that. So, and I really do feel, and we feel here at GoldenCare, that the short-term care market can save the long-term care industry in general. So if you look at long-term care plans, they had the 2, 3, 4, and even 5 and unlimited benefits, where short-term care is maxed at 1 year. The inflation greatly increased that exposure and risk. The short-term care plans kind of limit some of those inflation things. They do have them, but it limits that blow to the carrier. You don't have that risk of catastrophic claims. I think Gemworth has a thing that goes, the longest current long-term care is something at $2.6 million and still going, some Alzheimer's ones. So these claims can be extremely large, put a lot of burden on those long-term care companies. So they've had to be very, very strict with how they underwrite things. There's a lot of apps, a lot of delays. There's complex certifications needed. So if you look at short-term care, there are no real catastrophic claims, so the carriers aren't afraid of it. You don't have, the underwriting's a lot easier. Policies get issued faster. The premiums are affordable and cheaper. It's just much simpler to do. There's no certification required. So really, the short-term care industry allows us to go back to the future and really be able to help a lot of the people that we're unable to help anymore because of cost, because of affordability, and because of issuing. It's so tough to get people through underwriting. Okay, so like I mentioned at the top here, and I'm guilty of this, I used to look at short-term care as a solution for a long-term care decline. I wouldn't really look at it until I had some that was declined, and I try to patch together with maybe a short-term care plan along with a home health care plan to try to, again, patchwork something together to equal the long-term care plan. And I guess it's time to abandon that notion. The short-term care plans no longer need to sit on the shelf and be kind of put in this category as a small, little, meaningless benefit. And part of, again, why I came up with this is a broker of mine down in Mississippi, very good long-term care agent, just said, they're just not the same. I don't want to waste my time with them. So it's really time to reprogram ourselves into thinking that these plans deserve to be in the conversation. What I like to tell people around here is, yes, short-term care deserves to have a seat at the big boys table. They've been kind of lumped in with your dental, vision, and health plans, your prescription drug plans, your home health care only plans. And so people don't really think of them as a real solution to long-term care or to a life or long-term care habits. But I'm here to tell you, and I firmly believe this, they do deserve to be in that conversation, and they do deserve their seat at the big boy table. Okay, so if you'll notice this, GoldenCare is partnered with a lot of short-term care plans. We've been adding more and more. So you'll see as this industry continues to evolve, more and more companies are going to start having these short-term care plans. to kind of fill that void where the long-term care carriers have backed away. We're just seeing an influx of these great new products. And I promise you, GoldenCare will be at the forefront there, help bringing these products. We've helped design them, like with Manhattan Life, the one I'll be going over today. We were able to actually roll our sleeves up and take an integral part in designing that plan. It's part of the reason why, again, my unbiased opinion here is that we did a great job putting this together. It really is a dominant short-term care plan right now. I do suspect the other short-term care plans coming will probably, I don't know, keep up with the Joneses, if you will. We're already seeing some benefits that are becoming more common. So we're really hoping that this short-term care market expands even more to really fill that void again of people who couldn't afford it or couldn't get issued plans. So we're able to help more people. Okay, so again, the short-term care plans are sweeping the nation. We have product availability. If you'll see here, most states are going to have some of the plans that are out there, whether it's GTLs or Aetnas that have been around for a while, the new OmniFlex or the new Wellaby, depending on the state you're in, you know, outside of the normal problems, New York, Florida, Washington, California, you're going to have a plan. And even in some of those states, we have other things to offer you. So suffice to say that if you have plans, you have clients, let GoldenCare find you, even if this is an OmniFlex map, even if you're not one of the OmniFlex states yet, there are other options. We can help you using similar techniques that we taught you today. So with OmniFlex, let me go ahead and do some comparison or get into the nuts and bolts here. So OmniFlex, what a great, strong new plan. You know, it's the flexible, comprehensive, robust benefits. It's got built-in restoration benefits. The Fast 50, which means essentially I can use half my benefit to pay family and friends. No questions asked. Affordable premiums, simple plans that are easy to understand, much easier underwriting, much faster underwriting. Sometimes policies get issued in a week. Claims process. You're going to hear me talk more about this, but it's faster and easier to hit the claims. There's no 90-day certification required like there is for long-term care claims, which is huge. I'm going to talk about that again in a little bit. You can insure up to people at age 89. Now, you know the cutoff for long-term care was typically 79, but how many 75, 77-year-olds were you getting issued? You know, I know that dang near half the business that we submit in long-term care is being declined. If you look at 70-plus-year-olds that are being submitted, less than a quarter of those are getting in. So it's pretty tough. So it's nice to have something that goes up to age 89 that will accept people. When I started in this writing my policy, you know, I guess it was 1997, 26 years ago, the average age of people being written long-term care was 72. You know, that's dropped all the way down to the high 50s now, but believe it or not, I would get most of my clients through underwriting. That wouldn't happen anymore. So anyways, the OmniFlex today is much bigger and much stronger than the old short-term care insurance policies we're used to seeing. And I hope, again, we'll get that point across. Let me go back to this no 90 certification requirement. And so this is such an eye-opener. With long-term care, as you know, to go on claim, you have to be cognitively impaired or unable to perform 2 out of 6 activities of daily living for a period that your doctor deems to be longer than 90 days. In other words, if you had a knee replacement, that's not going to be a long-term care claim because your doctor knows that you won't be needing care much longer than a month or two. And so to trigger a long-term care, your doctor has to say that this 2 out of 6 ADL deficiency is going to last for longer than 90 days. So all these ailments here, osteoporosis, cardiac arrest, heart valve replacement, bypass surgery, hip replacement, motor vehicle accidents, all these might be 3 and 60 days, 30 days, 60 days, 90-day claims. But you know what? You're extracting premium dollars. And as you'll see with an OmniFlex, we're talking about $400 a day or $12,000 cash a month. So, and it's very apparent that you're going to get over a knee replacement or bypass surgery or valve replacement. So the benefits do restore, and they restore on both the home care and facility side, each restore once. So you've got essentially 4 pots of money out there. So when we talk about restoration, you'll hear me talk about this more. I'm going to talk about restoration because it is huge in a short-term care policy because it does come into play. You don't even see restoration of benefits in long-term care policies because it so rarely came up. It was kind of a non-factor. And even you hear agents now, but yeah, but how long are you going to be? How many people go into a nursing home and come back out and recover? Well, they really don't. But people go into a home care situation, they may have a stroke, recover, later get Alzheimer's. These scenarios happen all the time. So anyways, the no 90-day certification requirement of short-term care is often overlooked, but very important. Okay, I promise you we're getting our comparison soon here. Monthly premiums. So look at what you can get for a short-term care premium. You know, when you're talking to 65-year-olds, if you spend $100, you can get $200 a day of facility and home care. That's $6,000 a month. I'll show you in a second what you can get in long-term care with that. But so in other words, you can get some real viable benefits for very affordable amount of money. Again, a 70-year-old can get a couple $100 a day of coverage, $6,000 a month benefit for $167 a month. That's unbelievable. Okay. All right. OmniFlex, fact is, can really pack a punch. This is for the agents out there that think that the short-term care benefits are small. There's not much there. It's not really worth their time. Take a look at the benefits you can get here. So in your facility, you can get up to $400 a day. That's $12,000 a month, $144,000 maximum. If that restores, it's restorable or reusable, so it's a $288,000 max. Home health care, you get up to $300 a day, which is $9,000 a month. 12 months again, that's $108,000. That's also restorable. So the potential of $216,000 there. Then if you did fully restore everything, you use both your pots. If you use your home care and your facility and your home care, it'd be $252,000. And again, if we restore both those, $504,000. Pretty strong. And if you put the inflation in there, which again a lot of times we do because it's inexpensive, look how these benefits add up. So essentially, the benefits can be over $1 million. So believe me, that's not the short-term care I remember. I remember 1-year benefits at a couple $100 a day, that didn't have inflation. So now we're talking about pots of money, robust benefits of over $1 million. And the rates on this, by the way, here's without the inflation for a 55-year-old in Iowa, we're talking about $90 a month to have a $288,000 maximum pocket in facility and $216,000 at home. $90 a month. And if you put inflation with that, it's $163. So believe me, you can get quite a bit for $100 for a 55, 60-year-old, 65-year-old. There's still a lot of benefits to be had. Okay. Again, before I show you the comparison of these plans, a couple more housekeeping. Why is short-term care so important now? Well, look at the average length of claims. And there's lots of stats of this. I just pulled out a couple of them. Any service whatsoever, about 3 years. Unpaid caregiving for about 1 year, 59% of people. Paid care, usually less than 1 year, 42%. Any care at home, 65% people, 2 years or less. In facilities, 1 year, 35%. Less than a year, 13%. Any facility off, 37%. So half to 2/3 of your claims aren't going much beyond a year or two, right? There's other stats out there. 90% of claims don't go beyond 2.5 years, 3 years. If you start talking about over 5 years of care, it's less than 2 to 3% of claims. So you just don't see a lot of these long claims. A majority of them, 2/3 of them, are very small. Okay, and over here on your right, you'll see that 73% of claims start at home, 9% in nursing home, 18% assisted living. So we all kind of know this, but just keep in note that look at how small these periods are. So sometimes I think with long-term care, we're kind of using a sledgehammer to kill a mosquito. Maybe you don't need to kill them with all that premium and all those benefits, right? Especially when they can't afford it and can't get issued. Some coverage is better than nothing. All right, so the last thing here. So this is just something looking at some of the GoldenCare, some of the business that GoldenCare and our partner AIM have written over the last just 3 years, Mutual Omaha business. So about 30 million premiums, so it's a pretty decent sample size. But about 65.5% of our policies have a max benefit between 2 and 3.5 years. So again, 2/3 of them are less than a 3-year benefit. That's what we're selling. Only 15% of policies that we sell are over 5 years. Average premium is $2,800. Most of our clients over age 65 have max benefits of 2 years or less. Why? Because it's just too expensive. Long-term care has gotten too expensive and hard to obtain. And let me show you what I'm talking about real quick. Okay, so what do I have here? I have a 60-year-old couple. Let's put it at 65. So, if I'm starting with a 65-year-old couple, I might do 4,000 and 100,000, right? And even with inflation there, take a look at that. We're already at $5,000. That's a little 2-year plan. It's hard. Actually, I got a 65 and 60. Let's do 2 65-year-olds. So you're talking to a 65-year-old couple. If I just small ball it here and give them a little 4,000, 100,000, it's only a 2-year plan. We're still talking at $6,000 of premium already. And so you can imagine if you're a 65-year-old couple and sure you'd like to sell them a 3 or 4 year benefit, Let's sell them, I don't know, 280,000 here. Let's move the benefit to 5, right? So let's give them a little more robust package here. Let's do $250,000. So it's a 4-year plan. Well, guess what? Look at that premium now, 11,000. How many sales are you making at that? Now, I've taught you how to be creative on this, by the way, so I'm just giving you an example, but you can see how your buying power gets whittled down with long-term care. Pretty hard to afford it. So when we see people over 65, most of what we see that comes across at GoldenCare here are small little 2-year benefits now because they just can't afford anything else. So with that in mind, we've also showed you this before, and it goes into our comparisons nicely. I have for years taught people that shorter and fatter is the way to go. I have been preaching this for over 10 years. And, you know, some agents have latched onto that. We used to sell in this industry a lot of 5% compound. And I remember 15 years ago when I would train agents, I'd say it's the absolute incorrect way to sell long-term care. You never sell 5% compound. It's too expensive. You're much better off to go with a higher amount to begin with and use 3%. So if you'll notice these, and the rates have changed over the years, the carriers have figured out that we were doing that. Mutual Omaha used to get most of their business at 5%. When GoldenCare kind of partnered up with them 15 years ago, they started getting a massive influx of 3% compound. And granted, partnership made the minimums at 3%, so we saw some of that. But that was largely, I think, of how GoldenCare has trained their agents to kind of keep premiums down. So just if you can walk through this, what's on your screen here, if you'll notice here, there's a $270,000 pot of money all 3 times. So all I'm doing with this $270,000 is I'm shortening it and I'm fattening it up. So the first example is a long, skinny benefit, 4,500 5-year, still going to equal 2,700. Terrible design. But again, if I were to take 7,500 3-year, I still have a $270,000 pot of money. But look at my premium, dropped to 86. Well, I just squeezed it down even more, 10,000 2-year plan. Still have a $270,000 plan. Look at my premium now, 58.25. So as I do some of these things, you're going to wonder, how can short-term care be doing these smaller benefits? Well, even in a long-term care chassis, you can get there, but I can't get anything lower than 2 years in long-term care. I'd like to drop down to 1 year. And by the way, for those of you keeping score at home, what do these benefits look at? This is for a 60-year-old, okay? So what do benefits look like in 20 years? Average claims happen around 81. Well, if you'll notice here, an example, 11,000, 13,000, 12,000. So I'm giving them more benefit in 20 years than there are with the first example. Now, there is a crossover point here, you know, 85, 90 years old. Every case is different. But generally speaking, the shorter and fatter you can make a policy, the better a deal it is for your client. And I'll also tell you, it makes a heck of a lot stronger policy. I'll show you that too. Okay, so looking at this example, I've been doing this long, skinny versus short and fat for a long, long time. And I've gone to short and fat 2.0, where now I'm at short and fat 3.0, right? Animation fell for this one. Oh, presentation one. Bear with me. All right, so now what we've done is, if you look at OmniFlex or short-term care plans, what I've done is I've taken that to 3.0. Now I'm taking that same pot of money, 288,000. I'm just going to condense it down to a 1-year benefit. So it's paid over a 1-year period. So now again, for 12,900, 18,000, and 24 years, $24,000 benefit, the OmniFlex comes in at 39.57. So you look up here again, the pot of money was 270, the premium was 58.25. I've lowered that even more and still gave him 288. And the benefit in 20 years, 25 years, a lot higher yet, isn't it? So, you know, I really do feel like the short-term care thing is a great option many times, shorten and fatten even more. Okay, time to compare. I got about 15 minutes here of comparisons. I'll turn it over to questions. I'm hoping again that this paints a picture of why or how this is happening or what's going on in short-term care, because it really is quite a changing the guard. I think short-term care is really going to take over for where long-term care left off. Okay, so this is OmniFlex versus traditional long-term care. This is a simple little, the long-term care plan I did was a 3-year, $4,000 a month. Okay, no inflation here, just 60-year-old female. If you'll notice here again, the rates are $1,900 on the long-term care. I did the same thing here. I did a $12,000 a month for 1 year. 90 day with zero, no inflation. And premium 1110, if you take out the $300 drug RX reimbursement feature that's in the short-term care, whether you get that or not, either way, the premium's here, $1,100 versus $1,900 for the same pot of money, right? Actually, it's a larger pot of money because you get $144,000 guaranteed on the facility. You get $108,000 guaranteed on the home health care. So if you add those up, you get $252,000, which has the ability to restore. Let's just not even put that in there for now, versus $144,000. So for that premium, I'd be taking a pretty hard look at the short-term care versus traditional long-term care. Why? Well, just think about it come claim time. Would you rather receive $144,000 over the course of 1 year? In other words, 1 year at $12,000 per month? Or would you rather receive $48,000 per year over the course of 3 years? 3 years at $4K a month. Well, I think everyone would rather take as much as they could up front, right? I mean, if it were you and you just won the lottery, would you rather get 144 over 1 year or 144 over 3 years? Pretty much everyone would say, I'll take the cash. Okay. All right, so now the real advantage comes claim time. This is the same example I just showed you now with that, smaller benefits here. So let's just say someone had a stroke, an example I just gave you. The OmniFlex here has got the 1 year at $12,000 a month. The long-term care has got the 3 year at $4,000 a month. So someone has a stroke, ends up in the facility for 15 months. I did 15 months just to make sure the traditional long-term care had the ability to pay out the whole thing because it's got a 90-day elimination period. So we have to wait for, okay, so being fair, after a 15-month claim, the OmniFlex you received $144,000. With a long-term care plan, you'd received $48,000. So, it's not hard for me to figure out that obviously if you're paying premiums on a short-term care, long-term care plan, I want to try to extract or get my premium dollars back out of that policy as quickly as possible. There's a value to me. If it takes me a long time to bleed those benefits over to me, I may die before I ever get to them all. So the quicker you can get your benefits back, the more advantageous it is to that client. Okay, remember the premiums here, $1,100 versus $1,900. Put a lot of argument in the short-term care there. Okay, another example, hip fracture. 6-month claim at home. Family did most of the care here. Okay. Again, not a hip replacement. Let's just say it was a bad fracture, slipped in the ice, a lot of care. Both of them qualified for benefits. Now, OmniFlex has the fast cash. It's fast 50, half the benefit, that $12,000 a month. So $6,000 a month can be paid directly to the insured. Okay. Excuse me, in the home care scenario. So that's a $9,000 a month or $4,500 a month cash benefit. Times 6 months, that's $27,000. With traditional long-term care, remember Mutual has a 25% cash benefit built in. So on a $3,000 a month benefit, you're getting $1,000 a month cash, excuse me, a $4,000 a month benefit. So after 6 months, your family would have been paid $6,000 to provide your care. With OmniFlex, your family would have been paid $27,000 to provide your care. Again, you see the premiums below. Last example on the claims. This is a hip fracture where it wasn't the family. This is an actual RN coming in and visiting 3 times a week. OmniFlex, again, you would have been paid $21,000. Why? At $150 a visit, right? Remember that OmniFlex is going to pay you the full $3,000 or $300 per day, regardless if the nurse charges $150 or not. Okay, so you're going to get a full payment of $21,600 after 6 months. Again, this is 3 times a week. For traditional long-term care, you're going to get paid $10,800 or less. If a basic nurse is only charging, maybe let's an RN, so let's assume it's going to be at least $150. Could be less, but so $10,800 versus $21,600. Again, lots of claim situations where you're much better off having a short-term care. All right, now let's do some real comparing here. This is, and I'm going to go ahead and hop out of presentation mode for a second because I want to make sure that you guys can see what I'm doing here. So this slide right here, OmniFlex is a 1-year benefit, so that's $12,000 a month benefit for facility, $9,000 for home care. So below that, I got $144K for facility. I've got $108K for home health care. So over here, I'm going to do a $6,000 a month benefit for a 3.5-year period of time. That gives me a pot of money. I'm trying to match it here. $252,000. Now, this is just being fair. I used a 90-day elimination period to save money for the Mutual Omaha long-term care. Then I put a 0 home health care waiver on here. With OmniFlex, I went ahead and went 0 and 0. First day coverage on both. Why wait 90 days? Okay. Now, inflation, I don't have a 3% compound on OmniFlex. I did 5% simple. But if you know 5% simple will double in 20 years, 3% combo will double in 24 years. So in the OmniFlex, it works out pretty well that 25 years later, they both about double. So annual premium, $29.36. If you get the prescription drug reimbursement, minus $300, which a lot of folks, I guess 60 plus are on at least 1 or 2 meds, pretty easy to get to that $300. So $2,600 versus, even without the $300 reimbursement, let's face it, $2,900 versus $7,100. The same pot of money. And by the way, if you use $252,000, that's it, long-term care. People can argue you'll never actually use your restoration of benefits. Well, you might. And so I'm already going to equal, just being fair, I'm going to equal what you got in traditional long-term care and with a chance to maybe double that. Again, $2,600 versus $7,000. Let me show you what I'm talking about there. I have the actual illustrations just because. So let me show you, first of all, the OmniFlex. This is a female, age 60, completely loaded benefit, $29.36. That's where that number comes from. And again, that's for the full $400 a day, 0-day elimination period, and $300 a day on the home health care. Let me show up right here. $300 a day there for 360-day period, 0-day elimination period. Premium for that again, $29.36. Mutual Omaha, single, $252,000 pot of money, just like the OmniFlex. $6,000 a month benefit to get to the $252. $7,154. Again, not trying to pick on traditional long-term care, but if it were my friend, my mother, I might take a real hard look at this OmniFlex instead. $2,900 versus $7,100 for, and remember, an OmniFlex an all-cash benefit, it indemnifies you the whole amount for the care versus a reimbursement amount. You don't have the 90-day certification period, and you get a restoration, and you get about 1/3 the premium. Okay, so let's look at this in a married couple then. So what happens if I then double those benefits for a married couple? I get a little discount here. Instead of being $2,900, you get the 10% discount. So it ends up being a total, same benefits. If I max everything out, age is 60 here, I've maxed out the OmniFlex, the premium's $5,502. With Mutual, again, I'm going to do 2 people instead of 1. Now that premium is $95.67. You know, before it was $7,000. You'll notice that the males are a lot less money than the females, and you get your discount there, 15% for having both applied. So the total there now is $9,005. So again, $252,000 pot of money, $6,000 a month. Premium's $95.67. So looking at those comparisons again, married couple, $5,202 versus $9,500. Again, $252,000 pot of money for each. I have a $12,000 a month benefit for 1 year, a $9,000 a month benefit for home care for 1 year. Here I've got $6,000 a month for 3.5 years. Okay, reimbursement. So that's how I get the $252. That's the policy max. That's all you're ever gonna get paid out of here. Remember, you get $252, and you have a chance of restoring that. Again, a decent chance with the short-term care not having the certification. A lot of small claims will happen. Okay, so look at those premiums. $5,202, $95.67. And with the inflation, by the way, 25 years later, these benefits will have all doubled. So, you know, this is kind of a dead heat all the way across here. If you know the OmniFlex, there's a 5% simple. It waits 5 years and then it starts growing. So in 25 years, it exactly doubles. Well, 3% compound, the 24th year is when it doubles. So the 25th year, these policies are a dead heat. Again, all these benefits you're seeing up here have all doubled at that point. So this is a dead heat. The only difference is one's 5,200, one's 9,500. So again, I'd have to take a hard look at short-term care. And maybe again, if the 60-year-old couple, maybe one has a health concern. Okay, there's no guarantee you're getting 2 60-year-olds through long-term care underwriting. Less money, ease of underwriting, ease at claim time, and then again, less premium. Okay. So I also want to do, that's traditional long-term care. And believe me, I'm not picking on Mutual of Omaha. I can do this against any. Mutual of Omaha is the best long-term care plan out there, in my opinion. So, you know, this can be done to any long-term care plan. Okay, my next example here again, that the hot product out there in the hybrid market, and I've done these comparisons, you know, to One America, to Nationwide, you know, Thrivent, NGL. We use all the products. We do all the, again, we work for all of them. There isn't any one solution that's better than every solution in every situation. It all depends on your clients. All I'm doing today is trying to point out to you that, again, short-term care deserves to have some, well, deserves to be at the big boys table. All right. So this is going to be a little comparison with OmniFlex versus Nationwide. It's actually together. I should change this together. I know. Not Care Matters 2. This is their together product. Okay, so if I were to take a benefit, $250,000 long-term care benefit at $7,000 a month, okay, that's a $250,000 death benefit as well. Let me just take a look at that, okay? And then the OmniFlex, what I'm going to do with the OmniFlex here is I'm going to match this long-term care benefit. I'm going to do a $250,000 pot of money, okay? My amount's going to be $12,000 a month. It's a little higher than $7,000. Nothing I can do about that. And then I also need to replace this $250 death benefit. I'm going to add a separate IUL to that. So let's take a look at this. So again, Nationwide together for that single female that wants a $250,000 long-term care benefit at the tune of $7,000 a month with a 3% compound, which at age 60 I think is important. And by the way, I'm using preferred for Nationwide here. I use preferred just because I'm trying to be as fair as I can. $250,000 death benefit. The premium for that with Nationwide, what did I say together on this? This is actually the Care Matters. The next one's together. I have a married couple. My bad. $9,527. Okay. Let's see. I'm here again. Okay. So let's take a look at these. Just for those of you again keeping track at home. Here is your Care Matters. Care Matters 2. 60-year-old female. $252,000 long-term care. Actually, it's $259,000. The death benefit here is $168,000. That's after 15 years. And by the way, this Nationwide, it's a pretty neat product. You know, it works out pretty well. It is an all-cash benefit. But if you look at it, in year 15, it's $168,000. Let's just do that quick. I went with, even though the first 15 years, it only pays you a guaranteed death benefit of $168,000. If you look and you get to year 25, that does ramp up to the death benefit there again. After year 24, we're talking about a death benefit now of $238,000. Okay, $238,000. I went ahead and rounded up to $250,000, but for the sake of the matter there. So again, premium on this. I lost it. $9,527 for $252,000 in long-term care benefits at $7,000 a month, a death benefit of $168,000 that does grow after the 15th year. So, and life expectancy is, you know, for females 84. So when I did out to age 84, I matched that benefit to about $240,000, $250,000. So what I did then to compare this is I'm going to go ahead and do that OmniFlex for a single person, which remember the premium on that was $29.36. Then I went ahead and I just did a $250,000 IUL, universal life. Premium on that was $34.23. Okay. So I added those. Actually, that's the SUL. Excuse me. The premium on that is $43.35. This is for a single female, $250,000 death benefit. Again, giving the Nationwide kind of the benefit of the doubt. So we're going to go ahead and ramp up to $250 right away, guaranteed, all fully guaranteed. So to put that premium at $43.35. So then what I did here in the comparison is I'm going to add that $43.35 to my short-term care premium. I'm going to guarantee them $250,000 death benefit. I'm going to give them the same long-term care benefit. And I would argue at $12,000 a month versus $7,000 a month, I could argue maybe even a little bit better benefit. Okay. So look at the premium comparison here. A lot less money to do it this way. And what does it look like at claim time? So we're going to look 25 years down the road here. The Nationwide, again, female, 95.27. The monthly benefit in 25 years is paying out now $14,230. Their guaranteed long-term care benefit has grown to $527. And they still have that guaranteed death benefit of $250. However, if they use long-term care benefits up, they don't get their death benefit anymore, right? There is a guaranteed minimum death. If they use up this whole long-term care amount, Nationwide is still going to give them $33,600. That's pretty strong, actually, in the hybrid arena. But you know why when it's that much more money, would I want to put my client in a situation where if you actually use it, you don't get your debt, you don't get your life insurance? Down here, I'm going to give them $24,000 a month of benefit. I'm still going to give them a $500,000 total benefit for long-term care. Okay, that, by the way, has restoration with it, so it could be twice as much. But let's just say it doesn't. Okay, so I'm equaling that. And then, by the way, if you use this whole thing up, we're still guaranteeing you $250,000. So a lot less premium for both benefits guaranteed, and really a solid benefit package all the way through. So if you can see here again, if I were going against a hybrid, I still might look at doing a benefit of some kind and maybe adding some life. And by the way, I just did this one over here. The reason people buy hybrids, in my humble opinion, is they don't want to use it or lose it. They're afraid of paying this $2,900 in a year for 30, 40 years. Well, this person's 60. The OmniFlex premium I gave you is $2,900. Let's say they do have that for 30 years. She lives to be 90, okay? Well, that's still only 30 years. That's only $90,000. Let's say she lives to 100. She's only paid in $120,000. So I wouldn't do a full-blown $250 if they're worried about getting their money back. I might just do $150K death benefit. I did that here, and my premiums again were $56.35 instead. So let's look at again the married couple. Will come out of this. So this here now is going to be all right. And this slide didn't switch. All right. This is the married couple. So this is the married. This is together. Apologize for getting the product names wrong on this slide. I don't have the quotes wrong. That I've triple checked. Okay. So I'm going to take a look at this Nationwide together. This is a $250,000 long-term care benefit with a $7,000 a month benefit, 3% compound. This comes with a death benefit of $250,000, which is right away all the way through the contract. It's a little cleaner contract, and this together is really kind of a neat product if you haven't seen it. One of the nice features is that, I did use a 90-day elimination period, and I used a 0-day on the OmniFlex again. And the 90-day with the Nationwide Care Matters together is they'll go ahead and retroactively pay that elimination period. So if you get to your 91st day, if you're on claim on month 4, the first 3 months, 90-day elimination, on month 4, they'll pay you for all 4 months. So they kind of retroactively go back to a 0-day, but you still have to satisfy the 90-day elimination period, the 90-day certification, et cetera. But it's kind of a nice feature there. So to be fair, again, I still use 0 on the OmniFlex for both eliminations on home and facility. So here, very simply, I took that same benefit with Nationwide for a married couple. That premium was $13,785. And here at the OmniFlex, I loaded up 2 of them. It was $5,502 for 2 people, 2 60-year-olds. And then I did a second to die life to get their $250,000 back. 34 or 33. If I add that up, it's $89.25. And folks, you are going to get these slides, so I'll clean up a couple, the together versus Care Matters together versus Care Matters 2. But other than that, the numbers are all in here. I'd be happy to share this with you. I know it seems like we're jumping around, but so here I want to show you these again just to make sure. So this is the Nationwide Care Matters together quote for married 60-year-old, and here's a combo between life and the OmniFlex thing. A lot less premium. So let me just show you these again. So here's a Care Matters couple, right? This is again a 60-year-old couple, female, male, 60 years old, $7,000 a month benefit. The total long-term care between the 2 of them, of course, is $543. All right, that's $250 each. The premium on that's $13,785. And their death benefit from day 1 is $252,000. And what I did here then, of course, the Mutual Omaha, or excuse me, the short-term care, here's a double. That's where I get the, oh, I just pulled it out. That's where I get the 5502 from. And then the life insurance over here, this is for a married couple. This is second to die. The premium on that is $34.23. That's again a $250,000 guaranteed death benefit for two 60-year-olds. Okay, $3,423. So that's where I get those numbers. $3,423, short-term care, $5,500. I add them together, I got $8,900 versus $13,785. And what does this look like at claim time? Again, for $13,000, I have a $14,000 a month long-term care benefit. I have a $527,000 total long-term care benefit. It's guaranteed. But here's the thing, it's that or again. So if I were to use up this whole 527, well, they do give you a guaranteed minimum death benefit of $25,200 in this example. But if I die in my sleep and don't need it, I get $250,000. If I use my long-term care all up, I get $25,000. But why would I want to choose between the two? If I'm going to spend that kind of money, wouldn't I go ahead and get a $12,000 a month benefit? A 504 and a guaranteed $250,000 benefit for, again, a lot less money here. So, and again, I can do these numbers. We can do these comparisons with any long-term care, any hybrid plan out there. We're not picking in any carriers. All I'm trying to show you today is I really do feel like OmniFlex deserves, short-term care deserves to be looked at in almost any situation you're selling in these days. Large, again, if you're selling a 51-year-old couple that's super healthy, they've got no health issues and they've got tons of money, look at long-term care, right? No doubt about it. If you've got someone who's got $100,000 sitting in a life contract, it's a dead life contract, it's got a cash surrender, it has to be moved. Well, that makes sense to do a hybrid. Maybe you got an annuity in the same boat. You know, it's not doing anything for you. It's just sitting there at $170,000, drawing dead. Well, then go ahead and move that into a hybrid. You know, there are situations, like I mentioned earlier, that every situation is going to dictate a different solution. All I want you to do now is this short-term care plan, namely OmniFlex, stands poised to be part of that conversation. It does deserve to be at the big boys table. It deserves to be at least a look for all of us as agents now as we're designing plans. So that's kind of all I had here. Thank you for attending. I apologize for having a couple of the numbers or labels there, but again, I'll get you a copy of this with the labels of these things cleaned up. But folks, you'll kind of see as you go through it. I hope what I've said has kind of resonated with some of you. Folks, again, in closing, we just have to take a harder look, I guess, at short-term care as a viable option. That's all I'm really trying to say today. I really appreciate you guys coming on today. We will get a copy of this out to you. If you don't have OmniFlex yet or other short-term care plans we're marketing, please call the office here at 800-842-7799 or visit our website at GoldenCareAgent.com. And we'll make sure we get you appointed. Talk to one of our marketers. Maybe you have a case that you want to run by us right now. Maybe you're working on a current decline case or just someone that you were maybe going to quote and would love to see a short-term care plan alongside of that. We'd love to go ahead and quote that for you. We'd love to help you. So I'm going to wrap it up here because we're already at 50 minutes, and I sure appreciate everyone being on board. Jeff Clark, again, GoldenCare. If you want a recording of this, it'll be emailed to you, but also any of our pre-recorded stuff for all the topics are at GoldenCareAgent.com under tools and resources. So with that, I want to thank you guys all for coming on board, and good luck selling out there.
OmniFlex. Put it in your portfolio today. Call GoldenCare at 800-842-7799.